Hey, if you are a searcher and you are looking to acquire a business with a search fund, then you've come to the right place because some point along that path, you are going to need a financial model to model out the acquisition that you're looking to complete. And so we have built a financial projection template built specifically for search fund acquisitions. And I'm going to walk you through how to fill out the template, how to fill out the model, the different input tabs, and then the outputs and what you can do with the model and how it's going to help you determine, how are you going to finance this with a seller note, some search fund investment, maybe an SBA loan, and does the deal cash flow? And then ultimately, does it provide any return to you as the searcher, to your investors? What does that look like? So I'm going to walk you through the template here, but before I dive into the details, just a little bit of background about me. My name's Adam Huxema. I'm the co-founder of ProjectionHub, and we help entrepreneurs create financial projections for potential investors and lenders. And we've been doing this for a little over a decade now. We have about 100 different industry-specific financial projection templates that we built out. And today I'm specifically focused on this search fund acquisition template. I'm going to put a link to this template in the description of the video below, so you'll be able to go there and grab that template. And if you stick around to the end of the video, as a thank you for sticking around to the end, I'm going to give you access to a coupon code that you'll be able to use to get a discount on this particular template. So with that, let's go ahead and dive into how this template works. So I'm going to have a start here on the At a Glance tab. So this is the profit and loss at a glance. After you've filled everything out, all the input tabs out, you're going to get a couple of different high-level graphs, some charts, and tables. And then this key ratio table is going to be important, especially if you're looking to get an SBA loan or other bank financing. They're probably going to expect a debt service coverage ratio of 1.25 or higher. That means for every dollar of debt service, you're going to have $1.25 worth of earnings, essentially, or net operating income to be able to cover that debt. And most lenders like to see at least a 1.25. Now, based on the data that I have input into the model right now, we've got plenty of room for error, plenty of margin here with a 4.64 debt service coverage ratio here in the first year. You're also going to get a 5-year income statement summary, a 5-year cash flow summary, a 5-year balance sheet, and then the income statement, cash flow, and balance sheet all broken down by month for each of the 5 years. Now, you're also going to get this investor return tab. So again, this is going to be kind of at the end of the process. Once you've created your projections, you'll see the cash flow before distributions for the 5 years. You can set a percentage here. What percentage do you want the business to hold in cash reserves versus what is eligible for distributions to yourself and your investors? Then you'll be able to set some sale assumptions. So let's say you want to sell the business in 5 years. After operating it for 5 years, the model is going to look out in year 5 and see what your EBITDA is in year 5 or in the sale year. You can apply an earnings multiple based on your industry that you would expect. And then that will give you gross sale proceeds. So in this example, gross sale proceeds of 15 million. Outstanding debt at that point is 3.5 million, giving you net sale proceeds of 11. Now the total equity invested based on the assumptions we put in here was 5 million. And so then we can see what's available. This is what was available for distributions to investors over the years, including the distribution, kind of the final distribution upon the sale as well. And so based on all of those assumptions, we can see, okay, here's our internal rate of return for the investors with the $5 million investment based on those assumptions. Now, since this is a search fund model, now you may, as the searcher, as the operator, let's say you own 25% of the deal, even though you did not invest, maybe you didn't invest any cash into the acquisition. So in that case, what you might want to do here in this estimated investor share of distributions, if this 5 million is from the initial investors, and you might say, okay, well, they're only going to own 75%. So I'm going to take that total distributions and multiply by 0.75. Because the remaining, the rest of the distributions might be for you as the operator. And so you'll now be able to see, okay, with 75% of distributions, you can see now here's what the IRR looks like for the investors that put in the 5 million. So that's just an example. But again, in order to do all of this kind of scenario planning here at the end of the model, we really need to work on our inputs first. So let's come to our input assumption tab here. And the first thing you need to know is that any cell that's highlighted in blue is an assumption that you can change without breaking something in the model. Now this first little section here is actually really important. You can set the projection start year and the sale acquisition month. Now, the model's a little finicky with dates. So if you were to say the projection start year was, let's say it's 2024. Okay, so that's the projection start year, but you don't buy the business until January of 2025. It's going to cause the model here. It's going to say, okay, well, we're starting the projections in 2024, but the model only displays and shows financials post the acquisition date. So since you set the sale acquisition month to January 2025, you're not going to see any data for 2024. And that's also going to impact some of these assumptions here in terms of the years that are displayed for the historical data as well on the input revenue and input expenses tab. So this is just something to be specific and careful about, that you want to make sure you put this in the way that you want to. So I would generally say, the projection start year should be the same year as the acquisition year. And then the other thing to keep in mind, let's say we change this to 3/1, so March 1st, 2025. And we look at the monthly income statement. What's going to happen is you're not going to see the first couple months because you didn't own the business at that point, right? So the projections are only post-acquisition date. So keep that in mind, how that's working. Let's set this back to January 1. And so the next thing you'll notice is that you're able to put in some of the balance sheet items here. So the accounts receivable balance as of the month of the sale, so December 31st, 2024, we've got 150,000 of AR. And then estimated days outstanding. This is how many days it takes to get paid after you make a sale. So if you're maybe in the healthcare industry, maybe it could be 45 days, 60 days to get paid from insurance. So this impacts how much working capital you will need for the acquisition, depending on how long it takes to get paid. Your inventory balance, you can put an inventory balance as of the acquisition date. You can also put in a projected inventory carried as a percentage of sales. So what this does is if your business has inventory, your inventory is likely to kind of follow your sales. So if sales doubles, the inventory you have on hand is likely to double, right? And so by saying inventory carried as a percentage of sales stays at 25%, that means as sales grow or decrease, inventory held on hand would increase or decrease as well. And then accounts payable, you can set your accounts payable amount as of the acquisition date, as well as the average number of days it takes to pay your bills. So we have 10 days in there to start with. You can enter in historical or existing debt, and you can say whether that debt is paid off in the acquisition or not. So it might be that you're going to assume some of the debt as part of the deal. So, but if it's paid off, if it's going to be paid off, you can select yes here. And you can set the interest rate and the remaining term on that debt. Now you can have new loans. So let's say we're going to max out a SBA 7A loan for $5 million, and we're going to do a seller's note for $500,000. And then we are going to have a search fund investment of $5 million. We're going to you'll notice that you can have this number here where here's the amount borrowed or the amount invested. And then there's another number here that is the amount used for the acquisition. So in many cases, they'll probably be the same, but they might not be. So in the search fund investment, we said, well, only 4.5 million is going to be used for the acquisition. The other 500,000 will be our working capital for the business as we get started. So with the seller note at 500,000, 5 million in SBA loan, and 4.5 million in investment, that's going to bring our total purchase price based on the debt and equity up to 10 million. Now let's assume this is maybe a niche manufacturer, and they have a building, and maybe they have some equipment. So $2 million worth of equipment and some furniture. That's their fixed assets. Maybe we expect to upgrade some of the equipment for 500,000 in October of the year that we acquired the business. Now, after entering in all those assumptions, this section of the model will calculate the goodwill that will need to be placed on the balance sheet for the acquisition. All right, let's move on to the input revenue. So with the revenue tab, what you're able to do is, let's say this is a contract manufacturer, And maybe this manufacturer also does some professional services, some product design services for their clients as well. So you have product revenue and service revenue. You can set different revenue categories up here. So you can enter up to 4 different types of revenue categories and then select them from the drop down. You can put in up to 5 years of historical revenue numbers. And then in this model, or in this section, you're able to select a prediction method. So what that means is, in this case, let me scroll over a little bit. We need to figure out, okay, how are we going to predict or project what 2025 revenue is going to be? Well, let's say we want to average the last year or the last 2 years or 3 years, right? So we could, let's say to start with, we're going to average the last year, which in the current year, there's no available months of data. So really, we're just taking the last year. We're taking 2024. We're going to take that, we're going to average it. So it's just going to be 2024's number. And we're going to increase that revenue by this percentage, so 3%. Now, if you want to decrease it, you could put a negative percentage in here as well. And then based on that, this is a calculation. It's going to take 2024 revenue and apply that 3% growth rate to come up with 2025 projected revenue. And then from there, in each of the following years, you can set a projected increase or decrease, a percentage in revenue. Now, you also have the ability to manually input. So you don't have to use this average current year or prior year. So you can just say manual entry. And then if you select manual entry, you'll have this item right here. You just say, okay, this is where I'm going to put in how much revenue I think we're going to do in this category. So I think we're going to do 5 million. And then you can also do that for these future years. So if you put in a smaller number, the model is going to automatically default to a percentage. But if I put in 5,500,000 or 55 million, that's not really what I meant to do, but 5,500,000 is going to realize that you don't intend that to be a percentage. And so it's going to automatically assume, okay, that's a dollar amount and that should be the predicted revenue. Okay, so I'm going to kind of undo what we changed there. So we're back to what we had. Okay, so that's how we enter in our projected revenue. There's one more thing I would mention here is that in the first year, let's say you want to get a little more precise with the monthly revenue, because what the model is going to do is it's going to divide the annual revenue by 12 evenly and just assume revenue is the same each year. However, if you wanted to, you have the ability to come over here and you can put in the specific revenue dollar amounts that you expect each month for each category. So if you need to kind of build that up over time, you can do that instead of just having that evenly distributed among the months of the year. So you do have that ability. All right, so let's move on to the input expenses tab. You do have some assumptions if this is not like an LLC or partnership where it's a pass-through, and if it's a corporation, for example, that is paying corporate income tax, you can put in your income tax percentages here when those would be paid. You can set cost of goods sold categories and operating expense categories. You'll be able to enter in your historical expenses from the seller. And here, similarly, we can do the average current year, average last year, manual entry, apply an increase or decrease to expenses, or a manual entry if we want to do that for any specific numbers. Now, this is where it gets a little bit different on the expense side here, because we can select expenses as a percentage of revenue or a percent increase or decrease. So let's say we said, well, cost of goods sold, we think it's just going forward, yeah, we're going to grow revenue, but we expect cost of goods sold to stay the same percentage of revenue. We think gross profit's going to stay the same. So we want to select percentage of revenue. This is going to tell you right here what percentage of revenue that expense line item was for the previous year. So what you can do, and what I often do, is I'll copy this, so Control C, I'll right click here, and I'll do this paste values. And so we can just copy and paste the values in here for the future years. And that way we can say, you know what, the percentage expenses as a percentage of revenue are just going to stay the same percentage in future years. Now that might be, a conservative approach as you're looking for financing to say, yeah, we think maybe we can do better, but we're going to project, let's just say our gross profit, our net profit margin stays the same, and see how that models out. Okay, so that is really it on the operating expense side. You will have the ability to enter in individual salaried positions if you'd like. You could put all the salaries up here in a line item up here if you'd like, but if you want to put in individual salaried positions, you do have the ability to do that down here. You can set their current annual salary, employer taxes, benefits, what month they're in the model they're going to start, and then how many of that particular employee you have. So if you have 5 engineers, you can put 5 engineers, 3 sales reps, and so on. Okay, so that is really it. That brings you back to where we started here, the at a glance tab. If you have any questions along the way as you're diving into this, please don't hesitate to reach out to us at support@projectionhub.com. And again, as a thank you for sticking around to the very end, if you go down to the description of the video below, there's going to be a link to a form. If you fill out that form, it will send you a coupon code that you can use to get a discount on this particular template. So hope that's helpful for you. And again, if you have any questions at all, support@projectionhub.com. Thanks.